Hi, I'm Justin Zaks, Vice President of Strategy at Moomoo Technologies. I'd like to welcome you to our sixth webinar of our monthly 7-part series entitled Experience Options Like Never Before. This is a series which will give viewers an exclusive opportunity to learn about a variety of topics related to options from industry experts at SIBO. I will be asking SIBO experts about their presentation, their professional lives, and their views on various options topics. So make sure to watch the entire show. I won't want you to miss anything. The educational presentation should be about 15 to 20 minutes, followed by questions for about 45 to 60 minutes total. This webinar series is part of a broader collaboration between Moomoo and SIBO that includes several in-person events and the introduction of index options on the Moomoo platform last November. Today, I'd like to welcome Stacey Gilbert. Stacey is an adjunct faculty member and instructor with the Options Institute. She's also the CIO and co-portfolio manager of derivatives of Glenmede Investment Management. The title of her presentation is The Greek Squad, Understanding the Options Greeks. Stacey's going to talk to us about the different types of Greeks, what they are, what role they play. She'll also show us examples and explain how you can use the Greeks in your options trading. Stacey will also talk to you about how the Greeks can be used in risk management and assessing your P&L. Her slides will be available in the webinar chat, and a replay of this video will be available in the app shortly after this live presentation and on YouTube in about a few days. Before we begin, make sure to go to moomoo.com to check our current sign-up promotions if you're not already a client. If you do enjoy this webinar, please check out the live section of the app under the Discover Moo tab to sign up and set a reminder for more of our informative upcoming webinars.
Great, thank you, Justin. As Justin mentioned, my name is Stacey Gilbert, and I'm an adjunct faculty member with the SIBO's Option Institute, or more commonly known as the OI. For those who may not be familiar with the OI, it has been the educational arm of the SIBO for over 35 years, instructing novices to seasoned traders in an accessible, fun, and engaging way. One of the things that I wanted to touch on is Justin had mentioned my current role, but I've been in the derivative industry for over 27 years. So the good news about this presentation is that I have been asked a wide range of options questions, and it continues to be my favorite part about presenting. So please do not be shy about asking a question. While my goal of this webinar would be for all of you to walk away being able to give your own Greeks presentation, I really think one of the successes would be if you get your questions answered. So with that, let's get started here. We're going to start with, as Justin mentioned, the title is The Greek Squad, but I cannot do anything in this industry without making sure that I am disclosing all of the disclosures that are necessary, and I will reiterate, and you'll probably hear me say this a couple times, nothing is a recommendation, and everything that we're going to discuss today is for educational purposes only. So let's get started here. What are our learning objectives for today? Well, we're going to explore the option Greeks to understand what role they play and how to consider them in your trading decision. So just for a little bit of history here, the Black-Scholes equation, we can go back to this. This is sort of what most people will use when they're thinking about pricing options. And it's a Nobel Prize winning model that was developed in 1973. And what I would say is took the complexity of derivatives and simplified it into a single model with 5 variables. So the risk measures that come out of this equation are known as the Greeks. And what I think is really interesting is you can look at the Black-Scholes equation and you can take the first or second derivative to get these Greeks. The good news is we're not doing that today. We're going to just kind of talk about each of these separately. But before we kind of go into this nerdy Black-Scholes model derivative or talking about these, I think it's really helpful to understand the risk metrics. So what are these Greeks? Let's talk about these first. Delta, gamma, theta, vega, and rho. My goal at the end of this is going to not just remind you of Animal House, you'll have something else in your mind as you're seeing these terms. So let's move on to our very first one here, which is delta. So delta, I'm just going to talk about what its actual definition is here. So delta measures the sensitivity to changes in the price of the underlying security. So basically how much something will move when there's a dollar price moved in the underlying. It can range from 0 to 1, but it's more commonly discussed as 0 to 100. So very rarely would you hear somebody say it's a 0.56 delta. They will most likely say it is a 56 delta. So they'll get rid of those decimals. Calls have positive deltas and puts have negative deltas. And with time, deltas can kind of approach 50, assuming that rates are 0. So we're going to go through a little bit of a snapshot here of what I call the options board. So what I'm looking at here is the S&P 500 index. It has a price reference of 5,595.76, and I'm looking at the options that expire on December 20th of 2024. So this is what the world looked like to me when I used to trade on the American Stock Exchange. You had your calls on the left, you had your puts on your right, you had your strikes down the middle. So just to kind of get familiar with this, as we're going to see this again and again and again, you've got your bid and your ask for your calls on your left, and then we have the delta, which circled in green for the call options on the left, bid and ask for the puts on the right, with the delta for the puts on the right. So you can kind of see a couple of things should jump out at you here. First, call options are positive. So you can see with the spot reference of 5595.76, the 4600 strike is 0.94, or what we would call a 94 delta. The 5600 strike is a 56 delta, and the 6600 strike is a 1 delta. Notice the puts are all negative deltas. So that 4600 strike is a -6 delta, and so forth. So what does this delta actually do? How can we think about what deltas are? I want to go through a couple of different ways to think about delta, and we may come back to this page. First and foremost, what delta actually represents is a hedge ratio. You may hear that term a lot. I think of this hedge ratio in a couple of different ways. First, if you think about that 5600 strike call that we were looking at, that was a 56 delta. If I were to buy one option, I now own 56 shares. So I'm long 56 shares at this point. In order to have no delta exposure, I would need to sell 56 shares. And that would take away all of that delta exposure. So I have hedged out my delta exposure. If we think about that 4600 strike, that was a 94 delta. That looks like 94 shares. So you start to notice a pattern here. The more in the money the calls are, the higher those deltas are, the more they're going to act like stock. And this is what I call the stock versus the optionality. If we think about that 6600 strike call, it was a 1 delta. So if I were to buy that call, there's, I should sell 1 share of stock to hedge that. It's not really a stock position. It's much more of what I would call the optionality position. So when I think of hedge ratio, it is how much does this look like stock? And in this case, with my 56 delta option, 56% of it is stockish. And the other 44% of it is what I like to call the optionality of the right, but not the obligation. And you're going to hear me use that term a lot because that's the really important term here with options. That right, but not obligation is what makes things have optionality versus being pure stock. The second part of delta, and this is incredibly common, and this is where my nerd comes out because it's actually wrong, but I understand why people use it. So if we think about that 56 delta call option, you'll often hear people say, well, there's a 56% chance that that option will finish in the money at expiration. It's close. It's not terrible. If that just helps kind of put your mind around what that actually represents, if the optionality aspect's too difficult to sort of rationalize, the probability of finishing in the money is an okay use for it. I will say the longer you go out in time or the higher the volatility is, the worse it is to use this rule of thumb. But for the most part, it's okay. So again, think about it from that 94 delta call option, which was our 4600 strike. It's basically saying it sort of looks a lot like stock, right? That optionality, mostly stock. I need to sell 94 shares to have no delta exposure. And there's, back of the envelope rule of thumb, 94% probability that that will finish in the money. So that's how we can think of deltas as how does this look like stock? The most important point about delta is how is it going to move with, how is that price of that option going to move with changes in stock price? So let's think about our 56 delta option. Stock goes up $1, the price of that option should increase by 56 cents. So that's how we can think about delta. It looks like a hedge ratio from stock. It also tells me how much my option should increase as stock increases. And back of the envelope rule of thumb, it's the probability to finish in the money. If I buy a call option, I now have long deltas. How can I minimize this delta exposure? How can I reduce the risk? There are 2 ways to do it. First, I can sell stock, and that will have eliminated my delta exposure if I bought a 94 delta call. and I sold 94 shares of stock against it, I have no delta exposure for that options position. Or I could sell another call against it that has a very similar delta number to it, and I can reduce my delta exposure. If I buy a 94 delta call and I sell a 74 delta call, I will be left with long 20 deltas in that scenario. And we'll go through a couple of these a little bit later. Hopefully the one thing that you're taking away from delta is delta really is how much does this look like stock, and how much will my option increase or decrease with dollar stock moves. So now we're going to go on to our next Greek here, which is gamma. So a couple things about gamma. This measures the rate of change of an options delta with change in stock price. Long options are long gamma. So now we're not talking calls and puts. Long option, long gamma, short option, short gamma, and max gamma for an expiration is that 50 delta option. So this is a lot of words. So far, I have no idea what this really means. Let's take a look at our option board again and then kind of bring it back to how we want to talk about and think about gamma. So our option board again, you can see our same deltas there. You can see gammas are now what's being circled. Gamma is the same on the calls and the puts. Let's think about what this gamma does. If we were to think about our 5600 strike call here, which has a 56 delta, if S&P 500, this SPX, were to increase significantly, we know at some point this delta has to look higher, has to move higher. It cannot stay a 56 delta forever. Let's just use a very theoretical example here. We see our 4600 strike is a 94 delta, 5600 strike of the calls is a 56 delta, 6600 is a 1 delta. If we were to move $1,000 higher, my 5600 strike would look a lot like my 4600 strike does now. How am I going to get my delta from 56 to 94? Well, this is where gamma comes in. Gamma helps us sort of figure out how much this is going to change over time, over these stock moves. I'm a very visual learner. This is just the easiest way for me to think about gamma. So if our call option has a curve to it, the price of calls, if we're looking at that theoretical call value over time, and if I'm only adjusting by a static delta over time, so if we're thinking about that 56 delta option, stock goes up $1, my option goes up by 56 cents, stock goes up another $1, stock goes up by 56 cents. At some point, I'm going to be far off this curve here. How do I get back onto this curve? That's my Black-Scholes value here. Gamma. The way I like to think about gamma is there's a couple different things here. First, gamma corrects that linearity of delta. That we know the option doesn't increase 56 cents for every dollar move higher forever. At some point, it has to change. That delta has to increase. That option, as stock moves higher and higher and higher, has to start to look a lot more like stock. How can I take something that currently is sort of like stock and make it almost all like stock as the stock moves higher? That's going to be what our gamma component does. The second one here, and I'm sure I'm going to get a lot of questions about this. I just want to throw these two terms out here. It's talked about often. You'll see headlines on financial newsletters that'll talk about gamma hedging, gamma squeezes. Gamma is, remember, if you are long an option, you are long gamma. If you are short an option, you are short gamma. One of the things to think about with gamma, what does gamma do? As an option increases, so let's think about our 5600 strike call. That was a 56 delta call. As my stock increases, I know that my delta is going to increase. So I'm going to actually increase in deltas. If you think about at the very beginning, I had 56 as my stock exposure. As stock goes higher, I know this is going to increase. So I get to sell stock higher and higher and higher if I want to bring my deltas back down. That's where the benefit is of a long gamma position. It's increasing my deltas for my long calls as it goes higher, and I get to sell stock higher and higher and higher. Conversely, if stock drops, my deltas are going to get smaller. I will become short deltas, so I get to buy stock back as stock goes lower and lower and lower. This is this gamma move, this gamma hedging. If I'm long an option and it's moving back and forth around a strike, I can sell the stock above the strike and buy the stock back below the strike. It's a term we'll probably talk a bit more about here, but just want to give you a sense of what gamma is. If I own an option, that means my deltas are changing in the way that I'd like them to as stock goes higher. I'm increasing deltas as stock goes lower. I'm decreasing in deltas. Importantly, with gamma, it's a second derivative. Really, the only way to hedge gamma is with other options. This isn't something that I can hedge with stock. This is something that if I buy a call option, I just need to sell another option if I want to reduce my gamma exposure. And just keep in mind, it doesn't have to be another call option. It's another option. So what is the lovely trade-off for gamma, right? That sounds like it is the best thing I could possibly have. If I own an option that when the stock goes higher, I am getting longer and longer. My stock position looks like it's becoming bigger and bigger. So I get to sell stock at a higher price. What has to be the offset to that? Welcome to theta. So theta, you'll often hear this referred to as decay. But sticking with our Greeks, it's actually theta is the technical Greek term here. And this really is one of two things. It's the change in options price versus time. That's exactly what it is, or it's known as decay. How much something will go towards zero. Long options pay theta. If I buy an option, keep in mind I got long gamma, that means I have to pay out theta. And if I sell an option, I am short gamma, and I get to collect this theta. So let's think just for a minute of how can we think about what theta actually is? Why does theta exist? And I want to use an extreme example here. If we think about stock trading at $100, and we think about this 105 strike call, there is value to this 105 strike call, whether we're looking 7 days out, 7 months out, there's value to that 105 strike call. If that stock never moves from $100, at expiration, that call is going to be worth zero. Today it's worth something. At expiration, it'll be worth zero. So this is my change in my option price versus time, with nothing else changing. What my option is worth today, when I have 7 weeks to go before expiration, stock never moves, that eventually has to go to zero. I'm long gamma this whole time, but I'm also paying out that right, but not the obligation to buy stock is a premium. It is a value, and it decays with time. So that's how I think about theta. So let's look at theta. How does it look versus our famous option board here? You buy an option, you're short theta. You're paying it out. Your option is decaying towards zero. That optionality loses its value as you get closer and closer to expiration. So we know it's going to decay with time. And you'll notice again, where does it decay the most? Right around this at the money, this 5,600 strike call is where the theta is the highest. So how can we think about theta? I think this is really the important part is what's our takeaway with theta? Again, the right but not the obligation has a value that decays with time. Eventually, it's just not worth as much. The ability to buy stock, if stock is currently 100, and we're looking at the 105 strike call, if it is 2 seconds before this option is about to expire and the stock is trading 100, that has very little value. But we didn't know that 7 weeks ago. So that value over time is that decay. When I was trading options, what I found most valuable, because gamma to me was somewhat of an arbitrary number. Somebody would say, I have 1,000 gamma. I'm like, okay, that's great. Tell me a little bit more about your gamma position. Where I always found gamma most helpful is with its relationship to theta. And I could tell a story of when I was trading, it was during the dot-com days. So things had crazy volatility. Things went crazy quite a bit. Again, if I'm long options, and I'm going to have that ability where my deltas are going to move in my favor as stock goes higher and move in my favor as stock goes lower, this theta is what I'm paying for this expectation that I will be able to trade stock, sell it high, buy it low, sell it high, buy it low, back and forth, back and forth. So I can remember over 4th of July weekend, I had 2 stocks, each had 1,000 gamma. One of them, of that 1,000 gamma, had 1,000 theta, meaning overnight, all of the options that I owned, that theta, that option value was going to decrease by $1,000. The other one, I had 1,000 gamma, but my theta was $250,000. So with one day, nothing moving, the entire value of all the premium that I owned was going to decline by $250,000. Gamma numbers were exactly the same. My thetas were very, very different. And for me, I've always thought of theta as a relationship to its gamma. How they look relative to each other helps me understand the risks that are associated there. And as you could probably think, the 1,000 gamma with the 1,000 theta versus the 1,000 gamma with the 250,000 theta. The biggest difference there is 1,000 gamma with the $250,000 theta was a .com stock. It was one that moved around a lot. The thought that I would be able to buy and sell stock all day long and make money on trading stock back and forth, i.e. my gamma hedging, was a lot more, it was a lot more valuable. That's what was being embedded in that option price versus, we'll say, the other one. Theta, how do you hedge it? If you have something that is going to decay with time, the only way to hedge it is to sell something else that's going to decay with time. So you can hedge theta with other options. So we're cruising along here a little bit. Now we're going to get to what I always consider probably one of the more important ones, because this was from a risk perspective. Again, if we go back to Black-Scholes, we talked about Black-Scholes had 5 variables that go into it. The one that is by far the most debated amongst people who would be standing in a crowd or when somebody is thinking about trading a stock, trading options on a stock, is Vega. Vega is looking at the volatility. And volatility, we know historical volatility we can calculate, but what's in an option is implied volatility, what the expectation is for movements going forward. And this just has a lot more debate around it, right? We can look at our historical volatility and take a guess, but as events change, as things change within just the broader markets, volatility itself can change. So let's think about what Vega is here. So Vega is just the change in option price with respect to a 1% change in implied volatility. As volatility goes up 1%, if I am long an option, it will go up in value because of volatility. Nothing else has to move, but when my volatility goes higher, my option price will go higher. For every 1% change, we talk about it in dollar terms. Similar to Gamma and Theta here, they are consistent. If I have long options, I am long Vega. If I am short options, I am short Vega. Again, we're not differentiating between calls and puts here. Owning an option owns Gamma, pays Theta, pays decay, and is long Vega, is long that volatility risk. As volatility increases, the price of the option should go up. Stock doesn't even have to move, just volatility increases. The price of that option will go up, calls and puts. And conversely, volatility goes down, the price of those options will go down. So let's look at our board again here. Our board again here. Similar type of thing that we've seen with both Gamma and Theta. Tends to be the highest at that 50 delta option. You could see there, it's in this case, calls and puts are the same, that volatility component's the same, and it sort of peaks at that 50 delta option. Couple of big takeaways here about Vega. Just as a side note, it's the only Greek not represented by a Greek letter. Justin and I were joking around before the webinar started. People used to joke with me like, well, isn't this one Kappa? I will tell you there is very little time that anyone has ever asked me, what is your Kappa exposure? Vega is the term that everybody uses. Vega is your volatility exposure. We try to be cute and come up with a whole bunch of other Greeks, but Vega is the term that at least everybody that I've ever spoken to uses. This is going to get a little wonky here, but I just want to explain Vega a little bit here, and hopefully this will help us understand the risks over time of Vega. So Vega, volatility. If I have a 1-month option or I have a 1-year option, volatility, the Vega is much higher. It's much more impactful on those longer dated options. So have your higher Vega versus your shorter dated options tend to have, in a sense, they look more like stock movement, or they're going to look more like Gamma. Longer data is going to have much more of a volatility component to it here. So I'm just going to use an example of where Vega, you can have a surprising P&L related to Vega. If you have a 1-month option and a 2-month option, and your 1-month option is pricing in an event like earnings, and the company comes out and says, no, actually, we're going to delay it. We're going to push it back to that 2nd month. That 1-month option that had this event in there, this earnings event, and we're making the assumption that earnings is what is a crazy event for the stock, tends to move it a lot. All other days are fairly boring. You took it from having a big event in your 1-month option, and it disappeared. So that volatility is going to go lower because that one event that we were expecting is no longer there. You could be long an option in your 1 month, the volatility comes out of it, that option decreases. The right but not the obligation is now less valuable because volatility is no longer in that 1 month option. It's always been in that 2 month option, right? Whether it was in the first month or it's moved to the second month, it didn't matter. The second month always had that as a day that was going to happen. So nothing has changed in that second month from that volatility perspective, which is just kind of an interesting way to think about Vega. As events move around, I call them kind of volatility events. As these volatility events move around from one expiration to another, these Vegas can change. So if I own second month option versus first month option in that example, I can have a very different Vega P&L. Lastly, like everything else that you've seen thus far, Vega can be hedged with other options. The one thing I would say is because of that Vega component matters more for longer dated options than shorter dated options, you want to stay really kind of fairly close within expirations when you're trying to hedge your Vega exposure. And you want to certainly be aware of events because events can certainly shift the volatility, the implied volatility of an option. It can increase it if an event moves into it, or it could decrease it if it moves out of that expiration, and that would impact your Vega P&L. All right, last one we're going to go here is Row. What I can say about Row is I don't think in the 27 years that I have actually traded options, I have ever really thought about Row. So the really important thing here is we'll define it first. And then in terms of when I think about Greeks with the most risk, Row isn't the one that pops into my head. So what is Row? It is the change in option price with respect to a 1% change in interest rates. So as interest rates change, the price of an option can change. We're holding everything else equal. Volatility is not changing, stock price isn't changing, nothing else is changing, just my interest rates. Interest rates are positive for calls and negative for puts. Here's one thing that's really important with Row. It really does matter for longer dated options. Longer dated options in my mind aren't just 1 year options. We can be looking at 5 year, 10-year options. Row really does have an impact there. But for the vast majority of where options are trading, and I'll say in the 6 month and shorter durations, Row is one of those things to be aware of, but not really a risk that you'll likely obsess over. And one of the reasons I say you're likely not to obsess over it is this is a 1% change in interest rates. Yes, the Fed just cut 50 basis points. That is actually a change there, 50 basis points. The vast majority of the time, we are not seeing large 1% changes in any 1 month. So thinking about what this is actually impacting. Let's stick with our options board here. You can see again, Row positive for calls, Row negative for puts. Kind of interesting if we think about the impact of what the actual impact of interest is for a put, the 6,600 strike put, if I were able to sell at 6,600 and collect interest on 6,600, you can see that that number is higher. I'm missing out on more interest here. This is why it's more negative for those higher strike puts and conversely for the calls here. And again, if we were to look at this over time, you'll see 1 year options, 5 year options, 10-year options, Row really starts to matter the longer you go out in time. So let's think about how we can put this all together in terms of actual trades, ways to think about, oh, sorry, I'll go through Row real quick here. Measurement of the cost of capital. Interest rates, that is the cost of capital. This is measuring how much are you giving up by buying a put instead of selling a stock, and how much are you sort of saving yourself by buying a call instead of borrowing money to buy the stock. This is the cost of capital. Longer dated options, most important. Very similarly, Row can be hedged with other options. Again, I would stress that a 1 month option is not going to hedge a 5 month or 5 year option for Row. You want to keep your timelines fairly similar if you want to hedge similar types of risk. So now let's actually think about how this is impactful to what we're doing here. So what do we know? We're trying to figure out what the P&L should be if we are long calls and stock increases. So I bought a call. I'll use my 5,600 strike call on the S&P 500. It's a 56 delta option. The S&P 500 has increased in price. So what do I know? That 56 call, that's increasing in deltas. I am long deltas. If I am long that call, this is positive for my P&L. I should be making money on my delta here. I should be making money on my gamma here. I am long options. When I'm long options, I'm long gamma, stock moving, that's a good thing. I am paying decay. This is going to come out of my P&L. Again, this is how we think about gamma versus theta. How much do they kind of look like each other? What's their relationship there? If I'm long gamma, paying theta, that's my negative. Here I am, I'm long calls and stock increases. Have I made any money on Vega? Well, what do we know Vega is? Vega depends on changes in implied volatility. If volatility is not moving, I shouldn't be making any money off volatility. If volatility is moving, if it's increasing, I should be making a positive Vega P&L by being long calls. If stock is going higher and volatility is decreasing, I could be making money on delta, making money on gamma, paying out by theta, and losing money on Vega. So it's one thing to keep in mind. Everything doesn't have to go your way at the same time. And Rho, again, this is going to very much depend on interest rates. If we are looking at something shorter dated, it is very unlikely that we're seeing much of a Rho impact. But if you were to tell me this were a 5-year option, I would really want to know, did anything change in interest rate expectations? So let's move on to another scenario here. Now we're going to be short calls and stock increases. So I've sold calls and stock is going higher. Well, here's a situation where I am short gamma. I have sold an option. I am short deltas because I have sold a call. If I am short deltas and stock moves higher, in some ways you could say I'm sad because I'm short and it's going higher. So I'm losing money on my deltas. I'm short options. My gamma, again, short options. And if it's kind of going the opposite direction, I'm losing money on my gamma. I am collecting theta here because I'm short the option. And again, Vega and Rho is very much going to depend on what's happening specifically to volatility or interest rates. So there's no real clear answer where we can say this is exactly what's going to happen in all situations. So I went through a lot there. I know I went very fast. It is a habit of mine. The good news is we have plenty of time for questions. I know Justin's going to take the lead here on questions. Please want to encourage you to ask anything and everything. If there's any slide that I went through too quickly, do not hesitate to have me go back and discuss it a little bit more. But with that, Justin, I'm going to turn it over to you.
Thanks for that great presentation. It was really informative. And I just like to remind everyone on the webinar, please type those questions in the chat. Stacey's here to answer them. I'm going to ask her a few now, and we're going to get it started. And first, I'd like to kind of just go back a little bit about your history and what career path led you towards the Options Institute and your position as an adjunct faculty member. What drew you to studying options, and what do you find so fascinating about them?
Yeah, no, it's a great question. So my background is, I like to say I was the accidental trader. I went to college to become a doctor, and I ended up leaving with a derivative offer. So somewhere along the way, things changed. What ultimately happened is I was a math major in college. I had no idea what trading was. I had very little understanding of Wall Street. I did not grow up in a family that just had a ton of exposure to Wall Street, but I loved probability. And I was also a Division I athlete. So you had two things where I loved probabilities, loved numbers, I loved solving problems, and I loved to compete. As I went through the interview process at my college, the firms that kept calling me back were all trading firms, which is just kind of amazing because I did not think that was a career path for me. And it turns out that a love of numbers and a love to compete is actually a great combination for somebody who's ultimately going to want to trade. So I ended up starting at Susquehanna International Group on the American Stock Exchange 27 years ago. And thought, yeah, we'll be here for a little bit. Let me figure out what this whole Wall Street business is. And I was there for 22 years, and I got to do amazing things at Susquehanna. I traded on the American Stock Exchange, both derivatives and ETFs. I ran the education department for a number of years, which is why I'm so passionate about education and why I'm an adjunct faculty member with the OI. I ran the derivative strategy team. Part of my time was going out to buy-side clients and teaching them about options, how to incorporate them into their investment process, creating option strategies, talking about investors of the information we could pull out of options to better understand the risks that were being priced into the market. And about 5 years ago, I was asked to come to Glenmede Investment Management to become a portfolio manager of derivatives running mutual funds. So very different career path than what I thought was going to happen when I went to college. But I have to say, I am incredibly thankful for all the trading firms that actually kept giving me the interviews, looking at my resume saying, okay, she knows nothing about finance, but we can teach her all of that. The love of math and the love to compete is what we think is going to be most important for the success in derivatives. So it may have been too much information, Justin, but there you go.
No, I think that's great. And I think you bring up a very good point that, that love of numbers, the love to compete, the love, for markets. These are the types of things that, our viewers here can realize this is how you learn through watching these types of webinars. And what you really have to have is the interest. And if you have the interest and you're going to develop, that ability to trade, and you're not going to do it in one webinar, but hopefully you're going to do this over the webinar series over many years, and you're going to get there. And that kind of leads me into my next question is Greeks are a tool to help you with your options tradings. And a lot of times when people think about options trading, they think there's two different parts I'm thinking about. One is your initial strategy selection, whether you're doing a spread, a naked call, a long put, or once you have that position, risk managing it. How do you use the Greeks for each of those, and which Greeks are more important for either strategy selection or risk management?
Yeah, no, it's a wonderful question. So the reason I think about derivatives first, so there's sort of two paths of derivatives. We'll say there's the path of broader portfolio hedging, just saying, I want to sleep at night. I'm going to buy this put. I'm going to sleep at night. It's kind of like thinking about buying insurance. In that sense, that is really a decision for longer term investment objectives. The Greeks are probably less significant because you're likely not trading that hedge in a sense. Where I think the Greeks are most important is if you're putting on a position and your expectation is that at some point you will trade it before expiration. It's not just to set it and forget it. You're trying to think about, what was I thinking? Why did I buy this position? And now what should I do with this position? So let's use an example where there's a stock that you love and you're thinking about heading into earnings. Your expectation is that this should be a really positive earnings period for them, but you don't want to buy the stock. It's just too much to fork over in terms of money. You're really kind of looking at the optionality of owning calls. So you decide what call you want to buy. The minute you buy the call, the things to realize is the minute you bought that call, you bought some Greeks. You bought Greek risk. Now, what you decide to do with it is kind of dependent on what your expectation was of why you bought the call. The minute you bought the call, you are long deltas. If this stock is $100 and you bought something that was in the money, so we'll say it's a strike 99 and below, we'll call it a 90 strike call. That delta is probably, we'll call it maybe a 75 delta right now. All else being equal, if nothing changes between now and expiration, that delta has to eventually become stock. It's going to look like stock because we know that call, you will have the right to exercise it and get 100 shares of stock. Therefore, at some point, it has to become 100 delta. So you bought it when it was a 75 delta, you went away on vacation, you came back, you're like, oh my gosh, how is this a higher delta now? That's how this optionality changed over time. So one of the things you can think about with that is if you didn't want that delta exposure, you can obviously be trading other options against it or stock. You bought that call. What are the other things we know about it? You took on gamma. By taking on gamma, this means that as stock increases, your delta is going to increase. As stock decreases, your stock is going to decrease. You're going to have different sort of stock exposure over this time. How do you pay for that stock exposure? That option is going to decay. You have theta to it every single time. Right. So this is all kind of a component of, hey, I like this stock heading into earnings, but look at all this other stuff I brought onto this. So again, if you're just saying, I'm going to see how it plays out over earnings and reassess, then you're really looking for that big stock move. And then you're just saying, okay, how do I want to profit here? And you're not really thinking about the Greeks. If you're saying, here's a position I'd like over time, and I'm not as focused on an event, you need to be aware of the Greeks and how they are going to change over time. So I think of it as kind of two different things. As there's a risk management tool aspect to it, and then there's a trading aspect to it. When you buy an option, why did you buy it? And what was your plan all along? If it was just to hold it, then don't open the account again. But my guess is you were planning to trade around it, which means you have to understand the Greeks behind it.
That's a very comprehensive answer. No, that's
I
very
told
good.
you
Very
I'm an
good.
overshare and I talk too much, so I apologize.
That's great. And so just backing that out a little bit, and I want to combine one of my questions, and we have a user question here from the audience. A lot of people can't always. We want to go over one more time the positive and negative aspect in it of each of the Greeks. So some of them have a positive number, some of them have a
Yeah.
negative number, and then in relation to that, I have a question here from David. When doing a spread trade, do you add them up? Do you add the Greeks up? How does that work? So maybe you could talk a little bit about that positive and negative and addition, subtraction of understanding the net value of a Greek.
Yep, no, and that's a great question, David. And I should take a pause and go through this a little bit more slowly, because I think this is absolutely what you should be thinking about when you are trading a spread trade. So spread trade, first we need to define what this spread trade is. Are you buying one call and selling another call? And that's what we'll start with, that one first, just because if I could stick with calls and then stick with puts, and then we could think of calls and puts, mixing those together. Those are a little different. So I'd see, yes, that is what you're talking about. I will look at call spreads first. So let's go through our example of stocks 100. You buy that 90 strike call, we'll call that a 75 delta, and you sell the 110 strike call, and we'll just call that a 25 delta. So by buying that 90 call, you were long 75 deltas. And when you sold that 110 call, you sold 25 deltas. So net, you are long 50 deltas. So that's sort of your delta exposure. You reduced your delta exposure by selling that call. So that's how we got our deltas a little bit smaller. So now what happened to our gammas? Our gammas are probably fairly close in these two options. So you were long gamma on your 90 strike, and you became short gamma on your 110 strike. So there's probably not a ton of gamma exposure there, which means we don't have a ton of gamma exposure. We also don't have a ton of theta, right? As our 90 option is decaying and we are paying that out, our 110 option, we are collecting that decay. So you're sort of offsetting your decays a little bit there. And the same with Vega. They're going to be somewhat offsetting. Now, I should say the one thing and preface this with, the assumption was that 90 and that 110 call that you bought and call that you sold were the same expiration, right? If you're trading different expirations, Greeks look different as you go out in time. If you stay within the same expiration, or within, like, we'll say a fairly reasonable amount of time within that same expiration, you'll be able to reduce some of those exposures. So deltas will decrease, buy versus sell. Gamma will get to be closer to offset, buy versus sell. Thetas will get to be closer to offset, buy versus sell. And Vegas, very similar. Row is very similar, but again, if we're looking shorter dated within 1 month, there'll be fairly minimal row risk that you're looking at there. So that was, and then just think the opposite for puts. You buy a put, you sell a put, boom. Now we've reduced our put exposure, we've reduced our gamma exposure, we've reduced our theta exposure, we've reduced our Vega exposure. And actually, I think you bring up a really interesting point, because I'll tell you from my days of trading, the first thing I always did, if somebody bought an option from me, I always tried to figure out how I could spread off that option. And that's a term you may hear a lot. How can I spread off this risk? If somebody bought an option for me, I wanted to buy an option that looked very similar to it, so I could reduce some of my delta exposure, my gamma exposure, my theta, my Vega, my rho. So that is kind of the beauty of buying a call, selling a call, keeping them fairly close together in strikes. You're reducing a lot of those risks. The flip side is you're also reducing the payoff.
Great, great. And so another question that we get a lot is on Delta. And so a lot of people go in and they want to do a strategy, or just a single call or a put, buy or sell. And how do you take the Delta into account? For instance, so say you have an out of the money call and you want to buy it. What delta should a trader look? Should they buy a 40 delta, 25 delta, 2 delta? How do they make those decisions?
Yeah, and so I talked at the very beginning that how did I really end up in this industry, and it had a lot to do with probability. And I do think of options as an expectancy. What's the probability of the stock to be above that strike at expiration? And what sort of payout do I expect it to have? So recognize, and again, I kind of stress that delta is not the same as probability to finish in the money, but it's a good starting point, good rule of thumb. So do you want the exposure? When I think of a 25 delta option, to me, whether it's a 25 delta call or a 25 delta put, you're really positioning for what I call the explosions. You really want either a big drop down or a big spike up. You're not looking for this slow grind up. The worst thing that can happen with a 25 delta option is you are directionally correct. The stock goes higher and it goes right to your strike. You lost all the premium that you paid for that call. It didn't go up enough for you. So when I think about, do I want to buy a 40 delta call? Do I want to buy a 25 delta call? Do I want to buy a 75 delta call? How much exposure to stock do I want? And what is my expectation for this movement? If I think this has the ability to tremendously spike for whatever reason, whatever analysis you're sort of thinking about why you want that exposure, then you can go with a lower delta option. If you really want the exposure and you want this constant stock exposure, how much does it look like stock? You're going to want to go with a higher delta to have that higher stock exposure. So a lot of it ultimately will depend on why are you buying the option? One of the things I'd be very careful of is don't just buy options, think the stock's going to go higher and you're going to win, because you probably won't. Again, a lot of times that scenario that you're going to have is that 25 delta option. You were right, stock went up, didn't pass your strike. And you're like, oh, I hate options. This is why I never trade options. No, you just picked the wrong option, quite honestly, because your thesis, the way your thesis played out, that wasn't the right option to purchase. So a lot of it has to come down to, why are you buying this option? Just buying them randomly and fingers crossed is not really a particularly good strategy. Have a reason why, what sort of exposure do you want, and what's really kind of the expectation for movement going forward.
Yeah, that's a really good point. I think sometimes traders think about the strike. When they select the strike, they're thinking about, oh, I think it's going to go to that strike. Well, that's not good for if you're a long an option. It needs to go through, and a lot of times significantly through even the break even, because you got to pay for the option as well. So you not only do you need to make it to the strike, you need to make back what you paid for it, and that's just break even. So traders should always be thinking about, when that delta or that strike selection, it's like, that's, you want it to go well beyond that if you want to make make some money in that case. And so I think some of the other terms I think people hear around the Greeks that they might not understand. I'm going to have you walk through three of these, and one is delta hedging, gamma scalping, and delta neutral. If you could maybe talk about what the definition of these are and what they mean in trading.
Sure. So when I think of delta hedging, it is, if I buy a call, I'm long deltas. And if I want to hedge that, my hedge ratio, remember my delta is my hedge ratio. How many shares am I selling to be completely, I have a 75 delta call. The minute I bought that 75 delta call, I'm long, I have a position that looks like it's long 75 shares of stock. In order to delta hedge, I need to sell 75 shares of stock. Now I've delta hedged. The delta hedge is the same thing as delta neutral. I took the delta component, I took the stock movement component out of it. And you bring up a really interesting point. So delta neutral, what am I left with it? What did I just do if I'm delta neutral? Remember all those other lovely Greeks. If I bought a call and I sold stock against it in a perfectly delta neutral ratio, I still have gamma, I still have theta, I still have vega, and I still have rho. I cannot eliminate those by just selling stock. So a lot of times people may say, I want to trade something delta neutral. What they're really trying to adjust for is any stock movement that might be purchased immediately after somebody needs to buy that call. They're trying to take that stock purchase out of it so they can zero in on the rest of the Greeks in a sense. And gamma scalping is going to be something similar where, again, once I've gone, let's use a 50 delta option, because it tends to be, again, gamma's the peaks at that 50 delta option. I bought a 50 delta option. I bought one call. It looks like I'm long 50 shares. I sold 50 shares against it. Stock goes up. It's gone up $1. So now I know that delta is going to increase as well. So now it's a 55 delta call, because that's where my gamma component comes in. So now it looks like through my options, I'm long 55 shares, but I only sold 50 of them originally. So now I'm long an extra 5 shares. So I get to sell those 5 shares a little bit higher. And then what happens? Stock drops. And now that call is a 45 delta option. Well, I sold 55 shares a little bit higher, total of 55 shares a little bit higher. But now, because my call option is a 45 delta option, I'm only long synthetic 45 shares of stock. So I get to buy some back. And here's where I'm buying low, selling high, all around this strike. This is my gamma hedging. I'm sort of scalping back and forth and back and forth and back and forth. This is what's paying for my theta, hopefully, right? I'm able to like sell stock high, buy stock low, sell stock high, buy stock low. If it's going back and forth all day long, I'm flipping stock high and low all day long, and hopefully that's going to offset my theta. You'll hear these types of terms. They will become much more popular as you get closer and closer to expiration. Why does expiration matter? Why does this change the behavior of an option? Think about stock trading $100, and the strike you're looking at is 100 strike. If the top stock ticks up a penny, becomes 100.01, it is now a 100 delta option. The closer and closer and closer you get to expiration, if it is 3 seconds before expiration, if it ticks up a penny, it's a 100 delta option. If it ticks down a penny, it's a 0 delta option. That gamma is exploding, right? So you're going to have this closer and closer and closer. You'll hear people talk about pinning at the strike or gamma squeezes if people are short that strike, because they're going to have to buy high, sell low, buy high, sell low, and they're going back and forth the wrong way. So this is where gamma starts to have a bigger conversation, and you'll see kind of financial newsletters talk about it, the gamma hedge, the gamma squeeze, be aware of this gamma strike. That's the mentality behind it, is as you get closer to expiration, the stock that needs to trade around it, because that delta can be 0 or 100 within seconds.
Yeah, that's great. And, we've talked a lot about delta and gamma, and the other one I really want to talk about is theta, because I think, a lot of traders have a pretty good idea of delta, but when they get the theta, they don't quite understand exactly some of this, how, and it's so important, particularly short dated options. And I want to ask you first about this idea that, if you have a very in the money option that might be worth a lot more in premium, but it has a lower theta versus an at the money. Can you explain why that would be?
Sure. Yeah. So if you think about, I like to think about it sort of the opposite side of it. So if I know that there is a relationship between calls and puts on the same strike. So if I'm looking at a 94 strike call, it really looks a lot like stock, right? It's kind of 94% of it is stock. The other 6%, if you will, is the optionality of the right to, the right but not the obligation to turn this into stock. The flip side is that 6%, that other 6% is actually my put. It's really far out of the money. It probably doesn't cost that much because it's that far out of the money. It's a 6% probability of getting there. It's probably a lower option. Taking that from that lower price down to 0, it's just, the theta is not as high for that. My thetas are going to be similar for my calls and my puts. Now take me to my at the money option, my calls and my puts, right? These have value because the stock is going to move. These values, I know that this put option will be higher than that put option that was a 6 delta put. The 50 delta put, the premium on it is just higher. Well, this also has to get to 0 in the same time frame. So if it's expensive and my time frames are the same, and it's either going to be worth parity or 0, that theta gets really, really fast right at expiration, because it's going to be worth something or not worth something. And that sort of value that's there, that's built into it, has to decay very quickly. So I go in one day and I have some optionality to it because the stock could go up. And as I get closer and closer and closer to 4 p.m. when it's going to expire, that's where it's got to quickly get down to whatever its true value is. And it's going to get there faster. Whereas the other one, it just didn't start as high. The premium wasn't as high to begin with.
Yeah, I think that's a great explanation, and a lot of people will be helped in understanding that better. And then moving on to going back to delta, but then also thinking about vega and implied volatility. So you had talked about changes that these deltas can change if you have a theta change. But what about implied volatility? So can you help people understand? So if I have a 25 delta option, say it's 6 month, and suddenly my implied volatility of the stock goes up a lot for particular reason, how does that change the delta, or does it change the delta? Does it stay the same?
Yeah, no, it's a great question. So here's where I'm saying you can almost, in a sense, think about your option in one of 2 ways. If it's a 25 delta option, 25% of it is stock. The other 75% is this optionality of the right but not the obligation. And our back of the envelope it's the probability to finish in the money. When I take volatility from, let's just say, 20 to 200, what is the one thing that higher volatility says? Anything is possible. right? The higher the volatility is, the more likely any scenario is possible. So my out of the money calls, how much do they look like stock? They start to look a lot more like stock than they did, because it's entirely possible that they become stock. Their probability to finish in the money is increasing. Again, not a perfect comparison, but not a terrible rule of thumb. And my in the money options that I was so certain were going to be stock now may not have as high of a probability to be stock. They can kind of be anything as well. Or thought the other way, its counterpart, if my calls are in the money, my puts are out of the money, that out of the money put now has a higher chance of actually having some sort of value as my volatility increases. So volatility will make everything start to look like a 50 delta option. That's the one thing to think about. It all sort of approaches 50 because anything is possible. Now, a lot of this will depend on interest rates, whether it approaches 100 or just kind of stays at 50. But for most of the timeframes that we're looking at, they're all going to start to look like 50 delta options over time. It kind of becomes interesting as we think about the spreads. Well, you've sort of taken out a lot of that with the spreads, right? This Vega component, you took it out on both sides. So that volatility exposure, you've really narrowed it down to this exact moment of where the stock can be. And it's either worth something or not worth something. So again, this is why we say you can spread off the risk. And when you buy an option and sell an option, that's part of the risk that you're spreading off, because if volatility changes, you own an option that Vega is helping you, and you're short an option that Vega is not, you just don't have a ton of Vega exposure.
And that's good. That's great. And I think a lot of people, that's a great way to explain it in terms of it all becomes 50 delta as you get close. And a lot of times you see the changes, your time to gate fighting against this implied volatility. So this implied volatility, if implied volatility goes up, it could actually eclipse the decay of that option. So you could have, this odd situation where time, it's not decaying because you have implied volatility is something to be aware of. And then lastly, you talked a little bit about row. Obviously, row is not as important, but we do have a question from John asking about the cycle with row. And I think what he's really inferring is, not just this Fed meeting, but we have several Fed meetings coming up, and we might see 50 here, but we might see a 250 basis points across 6 to 12 months of a cycle. And so you spoke a lot about these longer dated options. Anything specific in terms of the at the money versus in the money, or particular implied volatility that we should be aware of with row when it's going to be super sensitive?
Yeah, the thing about row is really it is again, just remember it's the risk to 1% moves, and I fully appreciate the fact that we have 250 basis points potentially being priced in. The other thing to remember about options is, we talked about what historical volatility is, and we said what's actually priced into options is implied volatility, this expectation for future volatility. It's going to be the same with interest rates, right? There is an expectation that is priced into curves of interest rate curves, this expectation that the Fed will or will not cut rates. That is sort of priced in there. So if things are a surprise, yes, you can have more row exposure than maybe you were anticipating that you had. Row can become more of a conversation. Again, the vast majority of trading tends to be in shorter dated options where it's just not nearly as prevalent. But if you are trading longer dated options, particularly with some of the changes in Fed expectations, don't ignore row by any means. Longer dated options, just recognize you're taking on a lot more risks. Vega is a much bigger risk. Delta becomes kind of less of a risk out there. Vega becomes a bigger risk, and row becomes a risk. It actually becomes a conversation that you need to think about, particularly as kind of any surprises that may be out there. When you're in the shorter dated, it's probably less of an expectation because, believe it or not, we've done some work on the Fed, and you can sort of see they're not terrible at predicting what's going to happen in the next quarter. They're not great at what's predicting a year out, but they're not terrible at the next quarter. And if that's where kind of your expiration cycle is, the interest rate curve probably picks up most of that expectation.
Yeah, that's a great thought. So, I think as you explained, this is really more of a longer dated situation where you really have to be worried about the row. For these shorter dated options, 1 month and in, it's not much of a concern. And so we've covered all the different Greeks so far, the main Greeks. And at the end of your slides, you have some great information from the Options Institute, SIBO. Moomoo has a lot of great educational sources. And one of our questions from our audience from Prudence. She asked about a book, and so maybe I'll ask you about this book. And then also, if you have any other books that you might recommend or informational sources, Trading Options Greeks by Dan Passarelli. I don't know if you know that book, or if you have some other books in informational resources you might recommend for people to learn more about Greeks and then options trading overall.
Yeah, no, that's great. And I'm not really as familiar with that book. I would say the book that was probably most commonly used as I first started trading options was Shelley Natenberg's volatility book. So that's the book that I know best when I think about derivatives. One of the things that I think when it comes to Greeks, where I find it actually most helpful, and one of the things I think is worth thinking about is play around with simulators. That is the best way to get a handle. Like there are a number of ways that you can just say, okay, if I buy this call spread, how do my Greeks look different? Okay, now let me decay this over time and let me look at how this changes over time. I actually always found it most valuable to learn by hands-on, by real, and it doesn't have to be real money at risk until you feel comfortable with it, but there are models that actually will show you how an option decays over time. And if you are thinking, I want to buy a straddle, I want to buy this call, and I want to buy this put, what do my Greeks look like? Well, what do my Greeks look like over time? Well, what happens if stock changes here? What do I need to worry about here? That to me is the best way to learn, to actually see it. I am just not my brain does not process information through a book and be like, oh, that's amazing. My brain processes it through seeing numbers change. So for me, that was the way that I learned best, was simulating what happens with all the different changes between volatility, interest rates, stock, et cetera.
Yeah, that's an excellent point. I think combining the two things, theoretical through you get through the books and the practical knowledge you get from doing it are great. And the great thing about Moomoo is you're able to do that without risking money. So we have paper trading, and we also have an options calculator. You can look in and say, well, I think it's going to go here and it's going to take this many days. And so it's not always intuitive to say, well, how much will my 7-day option decay over 3 days forward? And if the delta, and if the underlying moves this much. And so, if you could calculate that, you have in your head, you have a good start, but
Yeah.
Here we have a tool you can use.
Exactly. And that's what I find. I'm a kid. I'm a tactile learner, right? Like, give me something that that's it. I can see it. So I'm a big fan of just having the ability to see it. I'm with you on that one, Justin.
Yeah. So like I said, we have one of these simulators in the Moomoo app. And so any last thoughts for our audience before we wrap it up here?
I would say, it's wonderful that everybody is trying to better understand the risks that are associated with options. Options are not for everybody. There are risks associated with them, and understanding them is incredibly important. And the risk isn't just, we know that if you buy an option, the risk is that you can lose the premium. If you sell an option, the risk can be theoretically unlimited. But there are other risks that are in there, and there are these Greeks. And when you're looking day by day by day, trying to figure out your P&L, this is important to understand them. And if you're going to trade around them, you need to understand what these risks are. So the better, more familiar you get with them, I think the happier you will be trading.
That's great. And I just want to remind everyone, this was great. And it's one step of your journey. And as Stacey says, options are complex, they're risky. So you need to put a lot of extra study in both Moomoo and SIBO, and the Options Institute have a ton of materials that you can watch and rewatch and read and reread. And speaking of that, we're going to be back on October 10th with another great SIBO webinar entitled Option Strategies Beyond the Basics. We covered some of the basic spreads earlier in the year, and we're going to speak with the Option Institute's Nishank Modi on some of these more complex spreads. And in mid-November, Moomoo is going to be hosting a 3-day webinar virtual event that will include a bunch of different webinars, including 2 with the SIBO on various options topics. So please keep an eye out for further details in your email and in the Moomoo community for that one. And please be sure to download the Moomoo app, and we'll keep you abreast of our upcoming educational webinars in partnership with SIBO, as well as the many other webinars we produce about trading in markets. The end of the slides, again, have links to some additional resources. Thank you, everyone, so much. And thank you, Stacey, for being with us today.
Thank you, Justin. Appreciate your time.